Hi, Chris Maloof with Cross Country Financial here. Rising mortgage rates have been in the news quite a bit lately. Curious as to how that's going to affect home prices and housing inventory? Stick around, we're going to give you some insight. Rising mortgage rates alone will not squash the housing market, but will definitely slow exuberance. The historic spike in mortgage rates instigated chatter across the country that the housing market is a bubble that will soon pop. Mortgage rates made a steep climb recently as markets reacted to a newly minted hawkish Federal Reserve. As seen in this chart, mortgage rates rose to levels last seen in 2011. However, we don't believe headwinds from higher rates will not fully negate the tailwinds of low inventory, pandemic reshuffling, and positive demographics. Other variables would have to turn over before the housing market materially declines. A 150 basis point rise in mortgage rates is probably not enough to cause severe demand destruction. Several months ago, a prospective home buyer would pay $1,347 a month for a $300,000 loan at 3.5%. If the buyer waited until this week to lock in a new rate of 5%, that borrower would pay $263 more per month. For most households, an additional cost of $263 per month will cut into discretionary spending, and prospective buyers will reconsider housing options. The initial response to higher rates will be most obvious for first-time prospective home buyers, who will bear the brunt of higher rates. This cohort will likely realign expectations or delay a home purchase altogether. But those selling a current home could be more adaptable to higher rates, since this cohort can likely offset high costs with existing home equity. Higher costs of funds will likely mean a cut in discretionary items most sensitive to relative price changes. Inflationary periods with high mortgage costs will weigh on the consumer, but if rates stay contained, our baseline expectation is the consumer will wade through it. Here come the millennials. Long-term demographic trends will support housing. According to the latest data from the National Association of Realtors, the median age of first-time homebuyers has risen to 33 years old. The median age of repeat buyers is 55. The wave of millennials coming into peak buying age and high net worth of boomers will help support the housing market, even though mortgage rates and home prices are rising at an extraordinary pace. Wage growth from tight labor market also provides support in the near term. Rising median age of repeat buyers, strong household net worth, and low financial debt obligations explain why all cash sales were roughly 30% of U.S. home purchases in 2021. As borrowing costs increase, all cash sales will likely rise in 2022. Years of underbuilding are suppressing housing inventory. Inventory of residential homes is at an all-time low according to Redfin housing market data. Other agencies corroborate at the current sales rate of existing single-family homes, the entire inventory would deplete in less than 2 months. In some regions, inventory of homes is more scarce. Perhaps some seasoned builders are reluctant to build after experiencing the great financial crisis, but the lack of labor and high cost of raw materials weighs on builders. Therefore, we expect inventory to remain extremely tight, adding support to housing even during times of rising mortgage rates. If you found this information beneficial, hit that subscribe button and have a great week.